Good morning, Oak Bloke here, and it's been a while since I've done a video, so been a very busy week. Excuse me, and a little bit worse for wear with the winter allergies and colds and flu. Anyway, enough about me. Let's talk about Regional REIT. So this is RGL, ticker RGL, listed in the UK, and it's based around the 2025 3Q results. So let me just throw this up on the screen. So it's um, this result here, trading update to the market that I'm going to be covering. Oops, today, if I can get the jolly thing to remain. There we go. On screen. So this article is going to be released in the next days. So it's, as I say, covering um, the September update. So this company's at a market cap of 163 million, net debt of 237, so it's 282 debt, 282 million debt minus cash. And these are estimates. Obviously, trading updates don't give you the full financial picture, but that's kind of about where they are at. The debt is fixed or fixed / hedged at 3.4%. So it's a NAV of 342.9. So as you can see here, it's on a nice chunky estimated discount of 52%. It has 581 even million pounds of property across different parts of the UK. So it's the clues in the name, Regional REIT, that it is a regional real estate investment trust. So yeah, I've covered this before a couple of months ago in this article called Wriggler's Revenge. So the follow-up is wriggling towards 2026. And I suppose the opportunity here was to kind of check back on in this article, and just quickly cover this. In this article, I said, even though historically, if I went further back into prior articles, I was negative towards Regional REIT, rightly so, because it had gone down in price and people got pretty badly diluted because they had to raise capital, and that raising seemed to be kind of it was a very real risk, very real risk, and it essentially they raised 100 and I think it was 110 million equity and diluted everybody by 50%. So I mean that's in the past now. That's behind us. So I looked at this back at its first half results and actually said, well, based upon what I'm seeing in the numbers now, I'm actually going to go from negative to positive because yes, office and even the first half 25 results weren't great. I mean, if we just quickly kind of cover some of these, they reported losses in the portfolio losses. They'd reported occupancy was down, so there was, it wasn't sort of all going Regional's way. But I suppose things that I liked about it was the splitting out of the portfolio into segments, and when you actually look at the core segment's actually pretty solid. The what they call the capex to core, that they're going to spend some money to renovate to get it to core, and they had shown some success. So this from core to capex to core here, they had some successes in turning that around and getting higher rentals at the end of it. So all for the good. In fact, post period, they've announced the sale of a property at 8.8, which is gain on its book price. And this is the other thing. They've made some really good progress in their disposal program. Now, in this article, I was a little bit cynical about that. I was like, yeah, we've heard that all before. They've tried to dispose of properties before, last year, the year before, when they were desperately short of cash. They were trying to dispose of properties and nobody was buying them. Well, guess what? In 2025, more people are buying these properties. They are selling faster, which suggests that the market is recovering. It's strengthening. So anyway, let's get into the detail here. Let's make this a bit bigger so you can see it a bit more easily. And So that's kind of where the share price is today. It's at a pound, or pound and a penny. I covered it back here when I said, well, looking at it, it's strengthening, it's getting better, and that I wouldn't buy it up here necessarily, or I wouldn't have bought it back here at these prices, but it had pulled back. So I said, well, it's sort of starting to get quite tempting, and at this price, it's in my opinion, pretty tempting. Now, not everyone will agree, excuse me, agree with me on this. Um, well, on one hand, you'll have certain voices saying it's in robust shape and in charge of its own destiny. Brave words. Not sure that that's necessarily the case. I think yeah, it's not as clear cut as that. Um, and then there's others that are very, very negative towards it, and potentially with good reason. It has been disappointing in the past. Obviously, its year-to-date performance is disappointing. I mean, let's look at that. It's down year-to-date to down to a pound. So if you bought it at the start of the year, you'd have lost money. So there are reasons to be negative about this share. I get that. I totally get that. I've sort of described it here that I think somebody called it I wouldn't even describe it as a cigar butt, as in you sort of getting it because it's free on the ground and there's a few puffs left in the thing, in the cigar. I've sort of said it's worse than that. It's somebody else has picked up the cigar butt and you're breathing in the expelled air. It's potentially that bad in terms of sentiment, in terms of how people view it. But I don't know. I mean, let's get into the detail of what the progress is. I mean, why am I positive towards it? Well, I was wrong on the disposal. That's the first thing to say. I was a little bit, um, yeah. It's not going to be as fast as all of that. Well, it's been pretty good. 38 million of disposals year to date at above book value. Okay, so that's above book value before sales costs. So obviously they've got to deduct out sales costs. And last year and the year before, it was like 1 to 2 million quid. So I've said it's above book value. So they actually made a profit on disposal. In other words, the price that these properties were at within the balance sheet, they were sold for more than what they're priced at. And bearing in mind that they've segmented these things into 4 slices, and this is like the rubbishest slice. This is the slice where they said we're not spending any money on it. We're certainly not keeping it. We're not renting it out. We're just going to get rid of it. So this is like the disposal. This is the bargain bucket part of the portfolio, and they're selling it off at above the price in the balance sheet. That tells you something, folks. Sorry, it really does. And they'd basically identified 93 million. So what I'm saying is, of the 93 million here, 40% of it, 38 million here, 40% of it has been sold in the 9 months. They reckon that by the end of 2025, that number will be higher still. That um, you know, might be, I don't know, 45, 50 million. So if it is, say, 45, 50 million, well, that's 50 to 60, 50 to 55% of its bucket of bargain basement stuff. Yeah. And value add is another area. So you can see here they moved quite a chunk of this and quite a chunk of this into the bargain bucket in the first half of the year. That's why this dropped from 93 to 56, is that they chucked it in the bargain bucket. But this is still this bucket here, value add is then sort of the next best again, the ones where, as far as regional or RGL are concerned, that they've got potential, that they can do a change of use. Like, I don't know, okay, maybe it's not going to make it as an office, but why don't we turn it into student accommodation? Why don't we turn it into flats? Why don't we turn it into an industrial unit? Why don't we turn it into shops? Whatever it is. Anyway, that's the idea with value add. Why don't we knock it down and build something bigger and better? So whatever it is, that's the value add bucket. Capex to core, meanwhile, well, that was 103 million in that slice, and they've spent 9 million on that 103 million, which is about 20% of their capex budget. I think they set aside they said they were going to set aside 45 million over time to get there. Anyway, so disposals last year and the year before they lost 4 million. So to kind of to make a profit instead of a loss, again, that tells you something. It's and bearing in mind as well that maybe in 2023, 2024, it wasn't just bargain bucket stuff that was being sold, it was perhaps some good stuff as well. So it does feel like there's a much stronger and different market this year versus last year versus the year before. Um, and I suppose the point is that when you can buy this company at 52% off, um, you know, and even the bargain bucket part of this business is selling at 0% off, or minus sort of 0.7% above naught. Well, it makes you think, well, why is it discounted at 52%? So I guess the next thing I then think to myself is, well, 160 million to buy 300 and um, 330, 340 million of assets. You've got to wonder whether somebody would just look at that and go, well, look, I'll give you 30% above the 160 million. I'll give you 210. Like, they walk away with 100 million of profit, no problem. The shareholders get offered 30%. They go and go, yeah, lovely. I get to make a profit, or I get to kind of make back the money I lost from buying it at the start of the year. Could you get that across the line? Potentially. Potentially. So is it a takeover acquisition target? Potentially. Now, the next thing I analysed was, I said, well, what I'm interested in is understanding whether things are going north or south. So you can sort of see south, 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 north. Okay, so the sales category, they've moved that from basically 30% of its sales, its bargain bucket, being rented, so 70% being empty. They've now dropped that down to less than 40% empty. Whereas here, I mean, yes, there is a slight decline, but 1.6% over a year. It's not great. I mean, I'm not saying that's a good outcome, but I think what is also the case, I mean, and it's obviously the difference here is even more stark, because that's a 6% decrease, and then here this is even more stark. This is a 15 or 16% decrease. So yeah, you could sort of say, yeah, that, like, Oak Bloke, what you on about here? Like, these numbers are all bad, bad, bad. Okay, yes, I get what you're saying about the sales, but then that's because they've got rid of the empty ones, probably. They've been sold off, disposed. But anyway, the reason that the excuse, I guess, is down to uncertainty due to the budget. So same excuse as last year: negatively impacted by uncertainty stemming from the environment and inconsistent messaging. So I've kind of made a couple of points here about, I won't say too much about it in case I'm accused of however you pronounce that word there. And anyway, that's kind of what the excuse is. But is it an excuse? Well, I tell you what I did was, I went and looked at Trinity, I went and looked at Schroders, I went and looked at Picton's, Apex Capital, and they're basically all reporting a drop in occupancy. It's not just regional, it's everybody. So this, that combined with the 2% tax from last year, obviously employers NI, it's kind of for those reasons that we're not seeing a great result from here through to here. But the obviously the 2% employers NI has worked its way through the economy a little bit. I mean, I don't know if you've probably seen in the past year that you go into your whatever shop and the prices have gone up, everything's gone up. Inflation's been quite sticky. People describe it as quite sticky. Well, it's not sticky. People have been stuck with a pass through of the taxes. I mean, that's all it is if you take employers NI 2% and add that to inflation, like true inflation is probably more like close to zero. It's just that there's been this 2% pass through of employers NI because that pretty much every product and service that is bought in the UK is going to be subject, at least in part, to that. Obviously, stuff that's getting imported in, you could argue, oh, well, that, there's no employers NI on stuff made in China or whatever, but you've still got, like, the cost of importing it, the people doing the importing, the business selling you the imported goods, 2% on that. So, I think that 2% inflation or 2% impact into inflation and so on. I mean, I think quite a bit of it is employers NI. And look, I mean, will we see something similar this time round? Will there be income tax, or will there be this? Will there be that? Will that affect um, employment levels? I don't know. I mean, potentially, but equally, do I think that they might have, excuse me, do I also think they might have to do something to turn around the growth? Because remember, this is the cornerstone policy of the current government, is to encourage growth. I find it quite hard to think that there won't be something, um, not least that the review of office rates and retail rates. I know that that's not going to be sort of cornerstone for RGL, but any kind of improvement sentiment would be a positive. And in any case, I think there is, to some extent, um, yeah, I just don't think we're going to see a repeat of last year's budget in this coming budget. So anyway, we'll see. But this is something that's kind of happening across the board. So you can pin it. You could sort of say, oh well, that's just a further example of how RGL are just hopeless and terrible, blah blah blah. Or you could say, well, that's just something that's going on, that's working its way through the economy, but having worked its way through, then the economy adapts. So anyway, moving to the capex core. So this is where properties will be upgraded. I kind of look at that as the examples that we've seen so far is that there's a 25% improvement to rental rates once they've upgraded them. So once they've become from a C to a B or a C to an A, and once it's all been tarted up with I don't know, nice soft furnishings or whatever they're doing, that the occupancy will go up and the rental rates will go up. And as I say, there are some examples given as to sort of what that looks like. And then we've got the third type, the value adds, where this kind of feels like it's a little bit, I've been thinking about this, where it's potentially, change of use and different things. So potentially a bit more of a long term. I think these sales segment will get, the bargain bucket will get sold off first. This is more of a sort of longer term strategic bucket that maybe a little bit, but probably not as much. The alternative use potential is greater than capex to core. Well, if capex to core potential is 25%, yeah, then it's got to be greater than 25%, which could be substantial. And the other thing that I did in my July article was assume that the bargain bucket was going to mean 20% off, like stuff gets sold off at 20% less than what it's on the balance sheet for. So far, that's not been the case. It's gone for more than what's on the balance sheet. So this minus 20% was just, again, me being a bit pessimistic towards RGL, whereas actually the proof now is that was unwarranted. I think the next thing I'm going to look at and talk to you about is just looking at the 4 different segments, looking at their current, so the valuation versus the current income. Then over here we have what's called the ERV. Now the ERV is kind of, if you could rent out 100% of it at market rates, how much would you earn? Okay, so like here, for example, the core portfolio, it is currently 88% rented out. So what would that be? About 12% upside. So it's about sort of 14% on top of 39.7 would be about 4, 5, 6 million. You can see over here the ERV is 44.8. So 44.8 would be about 5 million more than what they're getting now. Okay, so the idea is that you get this upside based upon occupancy, upside based upon market rates. What I did was because we know that because we know that thus far this year, this 5.2% is sorry, it's down here. Apologies, it's the other way. Because this 5.2% here is above ERV, in other words, the estimated rental value, the market rate for these properties is 44.8 million for the core. But these new tenants and these renewing tenants and this tenant in the current quarter, 8.3, 5.1, and the renewals at 5.2. So overall 5.1, 5.2 is kind of what's getting achieved. If I apply that to the ERV number, okay, I'm assuming in this little model here that these are all gone, yeah, so disposed, and I'm only disposing them at their book value. So I'm not making any profits. I'm just saying I'm going to get rid of them at what they're on the balance sheet for. Yeah. You know, the selling costs sort of are offweighed or outweighed by the gains, the small gains on disposal. Okay, bearing in mind that these are not bargain bucket, these are the bargain bucket. You know, so that kind of gets you to that number there. These remainder, if we say, well, let's add the 5.2 that we see that we're getting to the ERV, you can see, you know, today's rental, which includes what 11 million of these value add and sales. Okay, um, those disappear, but even so, what we get is these, which are currently about 45 million, jump to 65 million. Okay. And all I'm doing there is saying, what's the rental value today at 100% occupancy with the 5.2 on top of the ERV that RGL are telling us that they've actually achieved during 2025. That's not any future increases. That's not any capital increases. That is purely the rental. Now, it might be they don't get all the way to 65. A little bit further on down here, I do a different model where I say, well, what if they don't get 100% occupancy? In fact, they don't get occupancy of 100% now. So why should we assume that they'll suddenly get 100% tomorrow? Probably won't. Could possibly won't. What about if it's 90? Because 90 is like 2% more than what they've got today. That seems quite achievable to me. So there's a couple of things that I do to arrive at these numbers, and as I say, I don't feel that they're particularly aggressive numbers. I mean, even where I'm just saying, well, you know, this rental number here, I mean, not at ERV, but just sort of saying, let's take the this 36.8 and add 5.2 to it. Okay, so I'm not even doing anything other than just using this 5.2 of what we're achieving already today. And then here I'm doing the 25% uplift on this number magnified by 5.2% as well. I mean, even there we get to 50 million. Okay. So somewhere between 50 and 65 versus 56 today, bearing in mind that these disposals get you down to net debt of below 100 million. So net debt's at 230 today. Future net debt drops to about 80. And if you're paying 6% on 80 million, your interest cost is about 5 million. So your interest costs vastly reduced as well. So it's quite an interesting model. And when you look at the numbers that these guys are achieving, it looks a lot stronger than the current share price would indicate. It's also the case, I thought this was interesting, that they excuse me, that they disclose that rentals are increasing and the rate at which they're increasing is increasing. So they're outpacing central London, they're increasing by 3% a year. I mean, this is where we're getting that 5.2 from, is essentially that it's a couple of years, you know, and maybe 5.2 isn't the full story either, because actually, if this, I mean, what would you say, an average of about 2% over 5 years? I mean, 2% for 5 years compounded is not 5.2%. It's 11 or 12%, probably 12% actually, 2% per year compounded. And I think even though here we've got a zero, 3, 2, 2, 3, 2, 3, that gets you to 12. That gets you to 12. So it's interesting. It's also the case that you can see this was sort of the new office space that was being constructed, being built, bearing in mind that a certain proportion of office space is going to get demolished and, you know, sort of closed down, shut down, like beyond use, stuff that's grade below grade C. The government have declared that they are not going to be able to rent to anybody new after, I think it's 2 or 3 years from now. So there's a deadline to get your office property to an EPC of A or B, and if you don't, then you can't rent it to anyone new. You know, it's not to say that existing tenant wouldn't be able to carry on in that office, but as soon as they finish, then you're stuck. So the supply of offices is dropping. The covenants, so they've actually got their debt down to 282. They tell us that that is about 237 net of cash, and that gets you to about 40%, which was the sort of magic number of what they wanted to get to. So again, you know, there's a proof point that they said, you know, our ambition is to get to 40% loan to value. Well, they're pretty much there. I mean, maybe it's at 40.5 or something like that, maybe close to 41, but they are pretty close to achieving what they said, what they set out to achieve. And again, full credit to them for that. It's also the case that there's a bit of concern around the refinancing of the debt, and I talked about this in the last article. They say that that's well in hand, that they're already in advanced negotiation, and it's interesting because this first tranche of debt that's due next August is at 2.4 plus SONIA, which is 6.7. Will they be able to refinance at or below 6.7? You'd like to think the answer is yes to that. And it's interesting because there's a lot of people say, oh, well, cost of debt's going to go up. Well, that cost of debt's going to go down probably. The one that's actually renewing next year, the one that's renewing in 2027, to be fair, that one is at 3.28. So that one will go up. And then there's another one after that as well. So here they are here. So this one and this one are fixed, whereas this one and this one are actually percentage plus SONIA, okay, which is SONIA is at 4.3 at the moment. Now, 4.3 itself will go down, so I think it's potentially the case that currently interest rates are about 4%. They will drop to 3%, which would suggest SONIA will go to about 3.3, which would make that 5.6, 5.7, something like that. So it's interesting as well that if you consider that if disposals go through and debt is a net of 80, let's say, really this facility here in itself would cover. You know, so as long as they can get their disposals done in the next 2 years, that's 150 million in 2 years, which is a bit above what they've achieved this year. But even if they said, well, actually, yeah, we do need to have another facility and it will be, I don't know, 50 million, you know, that they've got 150 million at 5.6%. I mean, I've been running the numbers saying to myself, well, whatever outcome they kind of get to, like if interest rates don't go down, well, yeah, like let's try and minimize the indebtedness, you know, whereas if interest rates do go down, as appears likely, what's to say they can't get another fixed rate at attractive levels? I mean, maybe not at 3.3, 3.2, but maybe even if they get it at 4.5 or 5 or something. I mean, 5, if you had 200 million, I mean, that's pretty, that's going to be pretty competitive. That's 10 million a year. And then obviously you've just got to get a yield well above 5% to make that worthwhile, you know, minus costs. So I mean, this whole area of covenant breach has now, in my opinion, substantially gone away, and it feels very, very different to the knife edge that it lived upon in a couple of years ago. But the share price hasn't hasn't reflected that whatsoever. Yeah, I just think the debt's not, personally, I don't think the debt is anything to worry about. I mean, they can increase it if it's worth increasing it, and they can decrease it if it's not. They seem to have that freedom now, whereas before perhaps they didn't. So I've covered this a little bit already, so I won't sort of cover this again, particularly beyond just sort of saying, actually, this was an interesting number here, where if you actually take this ERV here, the 82.9, add 5.2% to that number, and then deduct the 56.7 million, well, that gives you a difference of 30.5 million, and 30.5 million on 56.7 would be a 53.8% increase to rental income. Now, I'm not saying, as I say, that would be based upon 100% occupancy at 5.2% above current ERV. But that's kind of the benchmark of what's the theoretically possible. And that is incredible. I mean, that's sort of assuming that there's no further strategic sales or value adds. They just get the ERV value, which is part of this 82.9 and is part of this 56.7, and just rent it out, which clearly the rentals on the strategic sales is not going to get to 100% in all likelihood. Yeah, I'm not saying that is a sort of it's a theoretical maximum. It's not a practical maximum necessarily, but again, I think that you can sort of see that there is potential upside. The lease expiry income profile. Now, in my July article, I spoke about this, and I said, "Oh, like there's a potential increase of about 6 million, which is this number here to here." But I was looking at this today, and I realised, to my sort of slight horror, that these lease expiry, this uplift, this 5.1, was 5.1 on top of ERV. So this number here, the amount being the amount that's expiring, this is sort of assuming that it is already at the ERV value. So in other words, and it's really touching into sort of what I'm saying here with this 30.5 million, this 53.8%, is that actually, if you run it not just not just here where I'm saying it's a 6 million increase. I thought to myself, well, no, how can it be a 32 million increase and a 6 million increase? It can't. And that's because I'm not taking account for the ERV. So actually, if you do take account for the ERV uplift, and then here all I'm doing is I'm saying there's a 2% average uplift to the uplift per year. That's where I'm getting my 32 million from. Okay, and that's the increase over time. Oh, yeah, and that was the other thing as well, that I'm only assuming that the uplift is going to happen at the point that the rent review happens. In other words, it's not to say that just because the market rate is now gone up by 10%, that everybody's rent goes up by 10%. No, I think the way it works is that you lock things in on a certain rate until rent review, and then at rent review, then you sort of have a review of what it's going to be and what it's going to look like at renewal. So there's kind of there's a jump only at the point at which these leases expire. That until they expire, the leases are locked in at a certain rate. So yeah, as you can see here, I mean, that 32 million gets profiled, but even just sort of taking like the next few years, I mean, you're still looking at something like a 15 million increase just based upon these uplifts for these elements of the leases expiring. So kind of what I've said is sort of like roughly a 9 million. I mean, that sort of tallies to this number here, sort of a 9 million a year short-term opportunity with a 32 million longer term opportunity, even without really considering what could be a more substantial increase to rental rates. And again, doesn't factor in any kind of capital gains on property. I think that's where I go next with this. And yes, so what I've done as well is I've said, yeah, 100% is 65 million. Well, what about if we just drop that down by 10%? What about if we just say no gains on capital, no gains on property valuation, um, and the finance expense drops because that's based upon a 6% at on I think it was 80 million a year at 6%, on 90, I think it was 90 million at 6% is 5.4 per year. That Actually, I've got myself thinking now. Anyway, whatever it was, the so the rental income wouldn't be 65, it would be 58. It was 65 back in 2024, by the way. And what I've done here is I've doubled the first half result to get that number there. So everything here is doubled to sort of say, well, in the future, um, the operating profit before finance costs would be sort of quite similar, but you can see the difference is that finance expense has dropped. So in other words, we're earning the same operating profit on a much smaller portfolio is what we're saying here. And the adjusted net profit. So this is where I'm just sort of ignoring the pass-through costs. Pass-through costs don't do anything. It's just, the costs of this, the revenues this, they're just sort of equal to one another. I'm assuming nothing on derivatives, nothing on property capital gains and losses. But you can see here property rentals alone more than double profits under this model, which assumes 90%, which isn't a lot higher than today. It assumes full disposal, so the 150 million of disposals, so that knocks down that finance expense. And obviously, if they don't fully dispose, then this number will be higher, and this number will be higher. And I mean, it shouldn't be dramatically different, obviously, compared to here. I suppose the point is that what you're doing is that this number is increasing naturally. This number is kind of including the low value stuff. So the low value stuff's dropping away. The higher value renewals and rentals are adding in. But the thing that's driving this is just the reduction in the finance cost. Okay, that's kind of how that model works and looks. But yeah, what you can then sort of say is, well, is zero gains on the capital actually realistic? Well, I suppose the point I've made is to say, well, losses on the capital, on the valuation of property. If we go and look at the results here, I mean, they lost. So that's the cash flow. Yeah, they lost 12 million in the first half of this year. They lost 37 million 6 months, sort of 12 months before. 56 million was lost in 2024. We went back to 2023. I think the loss was even bigger. I think it was close on. Yeah, I can't remember, but it was a substantial number. So loss. This change in fair value, I think we're kind of now getting to close to a point where that's going to turn around. And I think particularly when you consider that this graph here, where rental rates are increasing. I mean, if the valuation of property is dropping and rental rates are increasing, we've seen one that's ERV plus 8.1%. The yield is just going doubly fast upwards by double the speed, because the buy cost of the capital that you can earn the rental from is dropping, the rental is increasing, the yield is doubly increasing. Do you see? It's sort of going in two different directions in terms of the ratio. So I think that just does get to a point where you say, well, the capital losses are going to become capital gains. and it feels like we're at or very close to that point. If capital gains are 5% on a 500 million portfolio, I mean, that alone is 15p on a £1 share. So, about a 15% return just for the fact that offices are now in short supply. In other words, this supply has dropped off a cliff. I mean, it will take a number of years for supply to kind of come back online, because I think you can sort of see, that um, the appetite for new offices is just non-existent. But the demand for offices is existent. That's the point, that the take up of office space um, is into the millions of square feet. Yet here, under the millions of supply, it's what, 2 million here and virtually zero in the forward. Whereas per half year, this is about 4 million. So I think it was 3.7. Um, well, it says here 3.7 in the first half. Um, so yeah, sorry, these are, yeah, so that's 246, 7.5. So 7.5 million square foot is demanded. This is telling us in the big nine regional markets, versus what, just 2 million supply. So it feels that we are at or close to that turning point there as well. There's also the possibility that RGL could get involved with value add stuff. That's another possibility. I think the valuation, obviously, it's got a 10% yield, so that's very attractive. I think the capital gains could make it more attractive. The rental gains, or the increases to rentals, could make this attractive. Um, a 10% yield is kind of covered by rentals, more or less. The 15% increase on capital would turn that in from a 10% ROE, return on equity, to 25% return on equity. And just the replacement cost and value of property is much higher than its current actuals. So yeah, it does feel like a turning of the tide. I mean, yes, there are negatives. Yes, there's the budget coming up this week, which could give further bad news for commercial property. But somehow I don't think so. Somehow I think that this is kind of at the cusp of a turn. So that's kind of why I'm enthused. But look, none of this is advice. You make your own investment decisions, and um, this is an article that will be published on my Substack, which is theoakbloke.substack.com. I hope that's been a useful video for you to watch, and look out for this article on my Substack in the next couple of days. And thank you for watching. Cheerio for now. Cheerio.